There's a dollar amount, and the moment your account touches it, your own bank quietly starts reporting you to the federal government. And by law, it isn't allowed to tell you it's doing it. There's a second report with no dollar amount at all. It can be filed on a withdrawal of $200, and you will never be told it happened. And there's a newer one, a rule that lets your bank walk you into a back office and freeze your own money for up to 15 business days to protect you. Here's the part that catches honest people. The reports themselves, almost always harmless. Routine paperwork, they go nowhere. What actually ruins retirements isn't the rule, it's the thing good people do the second they find out the rule exists. Because the instinct that feels the safest is the exact move that can turn your own legal savings into a federal case. I'm going to walk you through 7 things about your own bank account that the system will never sit you down and explain. Every one of them is real. Every one is happening right now in 2026. And number 7 is a quiet 10-minute fix that protects more money than the other 6 combined, and almost nobody thinks to ask for it by name. If you're over 60 and most of your savings sits in one account, this is about you. If your mother or father is, this is about them. Stay with me to the end. Number 1, the $10,000 rule. And you need to understand it before you waste 1 second being afraid of it. There's a law from 1970 called the Bank Secrecy Act. Under it, every bank and every credit union in America has to file a report anytime you move more than $10,000 in cash in a single day, money in or money out. It's called a currency transaction report. And here's the first thing the internet gets wrong about it. It does not go to the IRS. It goes to a bureau inside the Treasury called FinCEN, the Financial Crimes Enforcement Network. You don't sign anything. You don't fill anything out. Your bank files it, keeps a copy for 5 years, and you will probably never know it happened. Think of it like the cameras over a highway. They photograph every car that passes. It doesn't mean you did anything wrong. This happens millions of times a year, and the overwhelming majority go absolutely nowhere. Nobody calls, nobody knocks. Sell a car for $12,000 in cash, walk it into the bank, deposit all of it, a report gets filed, and nothing happens to you. Hold on to that, because the very next move is where good people walk straight into a trap. Number 2, and this is the single most expensive mistake a retiree can make with their own money. When most people first hear about that $10,000 line, they all think the same thing. Fine, I'll just bring in $9,000. I'll break it up over the week. That decision, deliberately keeping your deposits under the line, has a name. It's called structuring. And under federal law, Title 31, Section 5324, structuring is a felony. Not a fee, not a warning letter, a federal crime. Here's the cruel part. The money does not have to be dirty. Clean money, legally earned, legally inherited, gifted to you by your own children. If you chop it into pieces to dodge that report, you've committed the offense. The penalty runs up to 5 years in prison and fines up to $250,000. And the government can move to seize the money through a process that doesn't even require charging you with a crime. And this is not theory. Between 2005 and 2012, the IRS seized over $242 million in cases like these, and a later government audit found that 91% of that money was completely legal. Ordinary people, widows, small business owners. So many innocent folks got swept up that in 2014 the IRS publicly changed its own policy and backed off legal source cases. So take a breath. This is not out hunting for you, but the law is still on the books. So the rule is simple. Deposit your money all at once, every dollar of it, and keep a record of where it came from. Never break it up to stay under a number, because the act of trying to stay under the number is the one thing that turns honest money into a federal case. Number 3 is the report that has no limit at all, and most people have never even heard of it. On top of that $10,000 report, there's a second one, a suspicious activity report. And this one has no floor, none. A bank can file it on a transaction of $500, $200, any amount at all, if the behavior looks unusual to the software that watches every account around the clock. And it is a federal crime for a bank employee to tell you one has been filed. So you could be flagged this week and have no way of ever knowing. What sets it off isn't the size of the money, it's a break in your pattern. Take out $300 a week for 15 years, then suddenly ask for $8,000 to pay a contractor, and the system flags the change. It doesn't know you're putting on a new roof. It doesn't care. It flags anything that looks different from your history, and anything that looks like the round number ducking from rule number 2. Which is exactly why you never want to walk in with a pile of cash and no story. Bring the paperwork that shows where it came from, and the flag quietly resolves itself. Number 4 is the newest one, and it's the reason you've heard that banks are freezing seniors' accounts. In the last few years, brokerages, under a rule called FINRA 2165, and many banks under their own state laws, were given the authority to put a temporary hold on the account of anyone 65 or older the moment they suspect that person is being financially exploited. The hold can last up to 15 business days, and it can be extended. It was written with good intentions, to stop a scammer from draining a grandmother's savings before anyone notices. But the same rule means a sharp, clear-headed retiree who walks in to pull out $20,000 to help a child buy a home can be taken into a side office, questioned about who the money is for and whether someone told them to withdraw it, and made to wait days while the bank decides whether to release their own money. And arguing with the teller does not speed it up. The way you stay ahead of it is simple. You tell the bank asterisk before the big withdrawal, not during it. Call the branch. Let them note it on your account. Name a trusted contact they're allowed to phone. That one step turns a multi-day freeze into a 5-minute conversation. Number 5 is the $250,000 line that most seniors have never actually checked. And this one is about protection, not punishment. Every account is insured by the FDIC, but only up to $250,000 per person, per bank, per ownership category. If you have $300,000 sitting in one account at one bank, and that bank fails, $50,000 of it is not insured, and you can lose it for good. And before you tell me banks don't fail anymore, in 2023, this country had 3 of the largest bank failures in its entire history inside the span of a couple of months. The depositors who were under the limit were fully protected. Everyone over the limit was at risk and only got rescued because of a one-time political decision that no law requires anyone to ever repeat. If you're holding more than the limit in one place, you can spread it across more than one bank or across different ownership categories at the same bank and bring every dollar back under the umbrella. It costs you nothing, and it removes the risk entirely. Quick thing before the big one. If one of these has already saved you a headache, take a second and subscribe, because number 6 is the part almost nobody shows you, and number 7 is the fix. Number 6 is the quiet mistake I promised you, the one that costs families the most, and it is almost always done out of love. At some point, someone tells a widow or a widower that the simple thing to do is add one of the kids onto the bank account, so they can help pay the bills, so the money passes to them easily later. It sounds reasonable. It is one of the most dangerous things you can do with your money. The moment you add your son or your daughter as a joint owner, that money is legally half theirs, which means if that child gets divorced, the account can be pulled into the divorce. If that child gets sued, owes back taxes, or files for bankruptcy, a creditor can come after the money in your account because your child legally owns part of it. Any one child you add can legally withdraw every dollar without asking the others. And I have watched that tear families apart after a parent is gone. It can hurt your eligibility for Medicaid. It can raise gift tax questions. And it can quietly override everything you wrote in your will, because a joint account usually passes straight to the surviving owner, no matter what your will says. The one thing meant to make life simpler ends up handing your savings to a lawsuit, an ex-spouse, or one child instead of all of them. Number 7 is the fix for all of it, the 10-minute move I told you to wait for. Instead of adding a child as a joint owner, you ask your bank for one thing, a Payable-On-Death designation, a POD. You stay the only owner of that account for your entire life. Your children have no access and no ownership while you're alive, so no creditor of theirs can touch it and no lawsuit can reach it. But the moment you pass, The account goes directly to the people you named immediately with no probate, no court, and no lawyer. It does everything people think a joint account does with none of the danger. It is free to set up, and it takes one short conversation at your branch. And while you're there, fix the amount too. The honest answer to how much belongs in a plain checking or savings account is about 3 to 6 months of living expenses. For most retirees, somewhere between $15,000 and $25,000. Not much more. Everything above that is barely earning a thing, and it's losing ground to inflation every single month. Move the rest in your own name, into a high-yield savings account paying around 4% in today's market, into treasury bills or savings bonds you buy straight from the government at Treasury.gov, or into CDs spread across a few banks so every dollar stays insured. You keep full control, you keep full access, and you finally earn real money on savings that used to just sit there being watched. Let me bring all 7 together, because there's one thread running through every single one. The $10,000 report exists, and your bank won't explain it. The structuring law can punish you for trying to be careful. The suspicious activity report can be filed on any amount, and you'll never be told. Your bank can freeze your own money for 15 days in the name of protecting you. The insurance only covers you up to a line you've probably never checked. And the joint account you set up out of love can hand your savings to exactly the wrong person. None of this ever comes looking for you. The bank does not call to lower your risk. The government does not write to tell you how to keep your money safe. The whole system is built so that everything stays exactly where it is, working quietly against you until the day you decide to stand up and move first. So here is the one move. This week, call your bank. Ask for Payable-On-Death by name. Name a trusted contact, and bring every balance back under the FDIC limit. 20 minutes total, and you'll be ahead of almost everyone your age. One honest note before you go: I'm giving you the rules, not personal advice. Every situation is different and the fine print varies by state, so run a big move past a CPA or an elder law attorney first. I'll put the exact form names, the law, and the websites down in the description. And do one thing for me. Send this to one person over 60 who keeps most of their money in a single account. Your mom, your dad, your sister, the neighbor, the friend from church who just lost a spouse and is about to add a child to the account because someone told them it was the easy thing to do. The odds are very good that at least one of these 7 is putting their money at risk right now. And one share from you could save them thousands of dollars and a freeze they'd never have seen coming. That's what we're here for. I'll see you in the next one.